Ask most people what caused the Wall Street crash of 1929, and you'll get the same answer, almost word for word. Greedy speculators lost their minds. The market collapsed in a single terrifying week. Bankers threw themselves out of windows. And that one crash, all by itself, plunged the entire world into the Great Depression. It's a tidy story. It fits neatly into a single paragraph of a textbook, and it gets repeated in documentaries, in economics classrooms, and in every op-ed that wants to warn you about the dangers of financial excess. There's just one issue with it. Almost none of it holds up. I'm not telling you the crash was a myth. It happened, and it happened violently. But the popular version, the one where a handful of panicked days in October single-handedly wrecked the American economy, is a simplified and, in several places, flatly inaccurate retelling of what actually occurred. Historians and economists have spent nearly 100 years picking through the wreckage, and what they've found is a story that's messier, stranger, and, honestly, a lot more useful to understand than the one we were taught. So let's go back and actually look at what happened, starting not with the crash itself, but with the decade that quietly built the conditions for it. When people picture the 1920s, they picture speakeasies, jazz, flappers, and shiny new automobiles rolling off assembly lines. Oh, that imagery isn't wrong. The decade did produce real economic growth. Electricity reached millions of new homes. The automobile industry exploded. Radios became a household fixture. On paper, the United States looked like it had discovered a formula for endless prosperity. And plenty of people at the time believed exactly that. What gets left out of that picture is who actually benefited from it. The wealth generated during the 1920s was extraordinarily lopsided. By the end of the decade, the top 1% of American households were pulling in close to a quarter of all national income. Meanwhile, the majority of American families, something like 80% of them, had essentially no savings to speak of. Wages for factory hands, miners, and farm laborers barely moved throughout the entire decade, even while corporate profits climbed sharply. The machines got faster, the factories got more efficient, and the money from all that new productivity flowed almost entirely to owners and shareholders rather than to the people running the machines. Economists have a term for what this produces: underconsumption. You can manufacture as many radios, cars, and refrigerators as you want, but if most of the population doesn't have the income to buy them, eventually the system runs out of road. That imbalance was quietly building throughout the decade, long before anyone on Wall Street noticed a problem. Rural America had it even worse. During the First World War, American farmers had ramped up production to feed a starving Europe. They bought more land, financed more equipment, and took on debt to do it. Once the war ended and European farms came back online, demand for American crops fell off a cliff and prices went down with it. Farmers who had borrowed heavily during the boom were suddenly stuck holding debts they couldn't service. Throughout the 20s, small rural banks failed by the hundreds, one after another, with almost no attention from the city newspapers. Most Americans living in New York or Chicago had no idea it was happening. So, before we even get to the stock market, we already have a picture of an economy resting on a shaky foundation, enormous wealth concentrated at the very top, a rural economy quietly collapsing, and a growing reliance on borrowed money to keep the whole machine running. That's the ground the stock market boom was built on. Now, let's talk about the boom itself, because the numbers are genuinely staggering. Between 1921 and 1929, the Dow Jones Industrial Average shot up roughly sixfold. Stocks weren't rising, they were rocketing at a pace nobody in American history had ever seen. The engine driving that surge was margin buying. Here's how it worked in practice. Someone could walk into a brokerage with $100 and buy $1,000 worth of stock, with the broker fronting the rest of the money and using the shares themselves as collateral. As long as prices kept climbing, everybody made money. The investor got outsized returns on a small stake, the broker collected interest and fees, and the banks funding the brokers earned what looked like a completely safe return. By the summer of 1929, the total amount of money loaned out for buying stocks on margin had reached somewhere around $8.5 billion, an amount larger than the entire money supply of the United States at the time. That's worth sitting with for a moment. The system was, in effect, a pyramid built on debt, and it only worked as long as prices never stopped rising. The instant they did, brokers would issue margin calls, forcing investors to either put up more cash or watch their shares get sold off. Forced selling pushed prices down further, which triggered more margin calls, which forced more selling. It was a mechanism built to spiral. And here's something the standard telling usually skips over. The people running the financial system knew this. It wasn't a hidden danger nobody saw coming. The Federal Reserve had publicly worried about excessive speculation as early as 1928, and in an effort to cool things down, it raised the discount rate significantly over the following months. It also sold off a large chunk of its government securities holdings to drain money out of the banking system. But raising interest rates doesn't just slow down speculators. It slows down everyone. Ordinary businesses found it harder to borrow. Construction slowed, manufacturing softened. By the summer of 1929, months before the crash, industrial production had already peaked and started declining. In other words, the American economy was sliding into a downturn before a single share was dumped on the floor of the New York Stock Exchange. The crash didn't start the slowdown, it accelerated one that was already underway. Now to the crash itself, because even the basic sequence of events is more tangled than most people remember. The market had already started wobbling in September, drifting down from its all-time high after choppy, nervous trading. On October 23rd, the Dow dropped several percentage points in a single session. Sharp, but not unheard of. The real trouble started the following day, Thursday the 24th, later remembered as Black Thursday. Selling began almost immediately at the opening bell, and it didn't stop. The ticker tape, the only real-time method investors had of tracking prices, couldn't keep pace with the volume of trades. It fell hours behind, meaning people across the country were making decisions based on prices that were already stale. A huge part of the panic wasn't caused by what investors could see. It was caused by what they couldn't. Nearly 13 million shares changed hands that day, obliterating the previous single-day record. Outside on the street, crowds gathered, fed by rumor and fear. Then, something remarkable happened. A coalition of the country's most powerful bankers pooled together roughly $250 million and began buying blocks of stock above market price, an old trick meant to project confidence and stop the bleeding. For a few hours, it actually worked. The Dow closed down only modestly. The next morning's headlines were cautiously hopeful, but the reprieve didn't last. Over the weekend, investors had time to sit with what they'd just witnessed, to think about the margin calls already piling up in their mailboxes, to think about money they owed and couldn't necessarily repay. When trading resumed on Monday the 28th, the selling came back with a force the bankers' coalition couldn't contain, and the Dow fell nearly 13% in a single session. Then came Tuesday the 29th, forever remembered as Black Tuesday. More than 16 million shares traded hands, a record that stood for decades. The ticker ran nearly 3 hours behind. People were selling blind, unsure what price they'd even get. By the time the dust settled, the market had lost roughly a quarter of its value in just 2 trading days. Here's where the standard narrative starts to fall apart, though, because what happened next rarely makes it into the popular telling. The market recovered, not to its absolute peak, but substantially, climbing back over the following months until, by the spring of 1930, the Dow was sitting close to where it had been before Black Thursday. If the crash by itself had caused the Great Depression, that recovery shouldn't have been possible, but it happened. So if the crash alone didn't cause the decade of suffering that followed, what did? This is where the real story gets interesting, because the answer is a chain of policy failures that turned a rough but survivable downturn into the worst economic catastrophe of the modern era. The first and biggest failure belongs to the Federal Reserve. People tend to imagine the Fed as an all-powerful institution that can steer the economy at will. Oh, but in 1929, it was barely a teenager as an institution, still working out what its job even was. In the years following the crash, it made a series of decisions that economists now consider among the worst in the history of central banking. Chief among them, it allowed the money supply to shrink by roughly a third between 1929 and 1933. That's not something that just happens on its own. It reflected a series of choices and failures to act by an institution that had the tools to inject liquidity into a collapsing banking system and largely chose not to use them. Why? Because of the gold standard. At the time, the value of the dollar was tied directly to a fixed quantity of gold, and the Fed was legally obligated to maintain that link. Expanding the money supply risked draining gold reserves and potentially forcing the country off the standard entirely, something considered almost unthinkable at the time. Faced with a choice between protecting the gold-backed dollar and protecting the domestic economy, the Fed chose the dollar. The economy paid the price. In the fall of 1930, the first major wave of bank failures hit, including the collapse of the aptly but misleadingly named Bank of the United States, a private commercial bank whose failure wiped out the savings of hundreds of thousands of depositors. There was no deposit insurance at the time. If your bank failed, your money simply vanished. That triggered a wave of panic, with depositors across the country rushing to pull their savings out before their own banks went under too, which, of course, only accelerated the collapse, since banks never keep all their depositors' money sitting in a vault. Between 1929 and 1933, more than 5,000 American banks failed. 5,000. And the institution that was supposed to act as the system's backstop largely stood by. Decades later, in 2002, Ben Bernanke, then a Federal Reserve governor and later its chairman, gave a speech acknowledging exactly this. Speaking to economist Milton Friedman, who, along with Anna Schwartz, had spent years arguing that the Fed's own mistakes caused the Depression, Bernanke essentially admitted Friedman had been right, and that the Fed wouldn't make the same mistake again. That's an extraordinary admission for a sitting central banker to make about his own institution's history, and it rarely makes it into the popular version of events. Then there's the Smoot-Hawley tariff, signed into law in 1930, raising import duties on thousands of goods in an attempt to shield American industry and farmers. Other countries retaliated almost immediately, and global trade collapsed by roughly 2/3 within a couple of years. Economists still debate how much direct damage the tariff caused versus how much of the real damage came from the Fed's monetary contraction, but there's broad agreement that Smoot-Hawley worsened the agricultural collapse, which fed directly into the wave of rural bank failures, which fed into the broader credit collapse. It wasn't the sole cause of the Depression, but it poured fuel on a fire that was already burning. Now let's deal with the myth that refuses to die. Bankers leaping out of windows. It's become cultural shorthand for the crash, referenced in films, books, and casual conversation for a century. It's also almost entirely fiction. Economist John Kenneth Galbraith actually examined suicide statistics from New York for October and November of 1929 and found the rate during those months was among the lowest of the year, lower than it had been over the summer, before the crash even happened. New York's chief medical examiner at the time went so far as to publicly debunk the rumor, noting that suicide figures for that period were actually down compared to the year before. Of the roughly 100 suicides and attempts reported in New York papers between Black Thursday and the end of the year, only a handful were tied to the crash at all, and fewer still occurred anywhere near Wall Street. The myth was largely manufactured by newspapers hungry for a dramatic image, and it stuck because it was simply too good a story not to repeat. There's also a persistent assumption that everyone was in the market, that shoeshine boys and secretaries and taxi drivers were all buying stocks right alongside Wall Street bankers. In reality, only a small slice of the American population, roughly 2 to 3%, actually owned stock in 1929. The crash devastated that slice badly, but it wasn't by itself what dragged the broader economy into a decade-long depression. What did that was the cascade of bank failures and credit contraction that followed. And while millions of ordinary families were losing what little they had, a small number of well-positioned people were doing the opposite. Joseph Kennedy, patriarch of the Kennedy political dynasty, reportedly pulled much of his money out of the market before the crash and made a fortune betting on falling prices afterward. Other wealthy investors did the same. The crash, like most financial crises before and since, wasn't a disaster evenly shared. It was a transfer of wealth, from the overextended to the well-informed, from the many to the few. It's also worth remembering this wasn't a purely American story. The gold standard connected economies across the globe, and the mechanism meant to keep the system balanced. Tightening policy whenever gold flowed out of a country turned into a vicious cycle during a downturn, forcing already struggling economies to tighten further. Britain, trapped in an overvalued position on gold since the mid-1920s, was eventually forced to abandon the standard in 1931, sending shockwaves through countries holding reserves in British currency. Economic historians have shown a striking pattern. The earlier a country broke free of the gold standard, the faster it began to recover. The longer a country clung to it, the deeper and longer its suffering. Herbert Hoover deserves a more nuanced look too. The popular images of a president who did essentially nothing while the country collapsed around him, so much so that the shanty towns of the era were named Hoovervilles in mockery. But Hoover actually did quite a lot by the standards of his era. He pushed business leaders to hold wages steady, increased federal spending on public works, and eventually created an agency to make emergency loans to struggling banks and railroads. The real problem wasn't inaction. It was that his response was badly undersized for the scale of the crisis, and some of his choices, including signing Smoot-Hawley and raising taxes to balance the budget in 1932, made things measurably worse. Hoover was operating from an economic playbook built for a very different kind of downturn, and it simply wasn't equipped for what the country was actually facing. It took Franklin Roosevelt's arrival in 1933 and the sweeping policy shifts of his first 100 days to begin turning the tide, taking the country off gold, launching public works on a massive scale, creating deposit insurance so a failed bank could no longer wipe out an entire family's savings, and establishing regulatory oversight of the stock market itself. So let's pull this together. The first mistake in the popular version of this story is treating the crash and the depression as the same event. They weren't. The market actually recovered substantially within months, and what turned a rough correction into a decade of suffering was the string of policy failures that followed, not the crash itself. The second mistake is the idea that nobody saw it coming. Warnings had been circulating for over a year before it happened. The third is the suicide myth, manufactured almost entirely by the press. The fourth is the assumption that speculation was some kind of national pastime shared by nearly everyone, when in reality only a small fraction of Americans owned any stock at all. And the fifth, maybe the most important, is treating the crash as the root cause rather than the symptom of much deeper structural problems: extreme wealth concentration, stagnant wages, a collapsing agricultural sector, and a fragile, undercapitalized banking system. There's one more layer to this that rarely gets mentioned, and it has to do with confidence itself as an economic force. Some economists, most notably Christina Romer, have argued that one of the crash's most damaging effects wasn't financial at all. It was psychological. Consumers who had been steadily increasing their spending throughout the 20s suddenly pulled back sharply, not necessarily because their own finances had changed overnight, but because the crash injected a level of uncertainty into everyday decision-making that hadn't existed before. Big-ticket purchases, cars, appliances, homes, are exactly the kind of spending people delay when they're nervous about the future, and that pullback in consumer demand fed directly into the industrial slowdown that was already underway. It's a reminder that economies don't run purely on spreadsheets and interest rates. They run on expectations. And once those expectations sour, the damage can spread far beyond the people who actually lost money in the market. It's also worth asking a question that most retrospectives tend to skip past entirely. Could any of this have been prevented, or at least softened, with the tools available at the time? The honest answer, according to most economic historians, is yes. The Federal Reserve had the legal authority to act as a lender of last resort, pumping liquidity into the banking system to stop the wave of failures before it cascaded. It largely chose not to, constrained by its commitment to the gold standard and by a prevailing economic orthodoxy that treated a balanced, sound money approach as more important than short-term relief. That's a choice, not an act of nature. Milton Friedman and Anna Schwartz spent years building the case, using the Fed's own historical records, that a more aggressive response could have kept the downturn from spiraling into a full-blown depression. Their argument was controversial for decades. Today, it's close to the mainstream consensus among monetary economists. It's hard not to notice how familiar some of these underlying conditions sound today. Widening inequality, wages that haven't kept pace with productivity, an economy increasingly leaning on debt and asset appreciation rather than broad-based income growth. None of that guarantees history repeats itself in the exact same way. But it does suggest the lesson of 1929 was never really about greed alone. It was about what happens when the institutions responsible for stabilizing a financial system respond to a crisis with the wrong tools, wrong assumptions, or simply not enough urgency. The crash of 1929 was, in the end, survivable. It was the years of decisions that followed it that turned it into a catastrophe. And maybe that's the part of the story worth remembering the most. Not that the market fell, but that the people in charge of catching the fall largely failed to do so, and millions of people who had nothing to do with Wall Street speculation paid the price for it anyway. The next time this crash comes up in casual conversation, as a quick shorthand for greed getting its comeback, it's worth remembering how much of that shorthand simply isn't true. The real story is longer, messier, and far more uncomfortable, because it isn't really about a few bad actors on a trading floor. It's about what happens when the institutions meant to catch a falling economy are working from the wrong instructions, and about how long the consequences of that can echo forward, well past the people who made the original mistakes. If this kind of deep dive into the history behind the headlines is something you enjoy, channel reach more people who are tired of the oversimplified version of events. And if you made it all the way here, let me know in the comments. Thanks for watching, and I'll see you in the next one.